Namaskar. This is Akhilesh Bhargava. Welcome to Tit-Bits on Business and Finance with me. Like in the case of any other comparable economy, the Indian economy also contracted severely during the financial year ended 31st March 2021 on account of the disruptions and the closures caused by the COVID lockdown. The global economy contracted and so did that of India. On the global front, the worldwide economy contracted by about 3.3% last year, resulting in a GDP loss of about $1 trillion worldwide and a trade loss of about $3 trillion. In India, the economy is reported to have contracted by about 7.3% in the previous financial year, even though we think that the economic contraction was much more than that and was in the range of about 10%. The economic activity contracted in the first two quarters of financial year 2021, but it was in positive territory in its last two quarters. The gradual pickup in the pace of economic activity from September last year was in tandem with the reopening and unlocking of the Indian economy. It, however, proved to be short-lived due to the onslaught of the devastating second COVID wave, which brought economic activity in India to a standstill again, only to pick up from May 2021 onwards. We even lost economic activity in April on account of the second COVID wave. The Indian economy recorded a quarter-to-quarter growth of a negative 24.2%, which is a contraction in the quarter ended June 2020. It then contracted by 7.5% in the second quarter ended September 2020. In December quarter, it grew by 0.4%. And then in March, it grew by 1.6%. That was the quarter-to-quarter growth in the last financial year. Due to this low base effect of the last year, any growth recorded by the economy during the current financial year is bound to look rosy and impressive. For example, based on a massive contraction of 24.2% of the economy in quarter one ended 30th June last year, the Indian GDP grew by a stunning 20.1% in the first quarter of this year, despite the fact that the fierce COVID wave had continued even in April this year. This to us is a statistical mirage. If you compare this growth of 20.1% with the same period in financial year 2019-20, then there is no growth but a contraction of 9%. And if you compare it with the immediately preceding quarter of March 2021, then it is again a negative growth rate of about 7.2%. The fact is that despite the growth rate of 20.1% in the first quarter of the current financial year, which is the quarter ended 30th June, the Indian GDP is far away from the pre-pandemic levels. Keeping these comparisons aside, it cannot be denied that economic activity indeed caught momentum in India during the quarter ended June 2021, despite the debilitating second COVID wave. The growth momentum of quarter one has continued in quarter two, that is the September quarter, and the September quarter recorded an impressive growth rate of 8.4%, again with the inherent support of a low base effect. It can also not be denied that the economic growth in quarter one and quarter two this year has had the one-time support of pent-up demand, revenge spending, and also seasonal festival spending of Diwali. 2 consecutive quarters of GDP growth in such uncertain times do not lead to any definite conclusion to us. And the question therefore is whether the current uptick in growth in the Indian economy is sustainable at a high pitch or not, and whether the consumer demand is strong enough in order to propel rapid economic growth in India quarter after quarter in the coming years. Before we discuss the underlying strength of economic growth in India, let us have a look at growth as recorded during the current year's second quarter ended 30th September 2021. The Indian GDP recorded a growth of 8.4% in the second quarter as against 20.1% recorded during the first quarter of the current financial year ended 30th June. The economic activity gathered momentum in the second quarter, and the performance of 3 key indicators is reported to have exceeded expectations and estimates. They were the core sector. The core sector represents 6 critical industries like cement, steel, electricity, oil and gas, etc. And this sector grew by about 7.5% in the month of November 2021, as against a mere 0.5% growth in October and about 4.5% growth in the month of September. The second is fiscal deficit. Fiscal deficit during the April-October period was a mere 36.3% of the budget estimates, showing a significant improvement in government finances. And finally, the third factor is that the GDP grew by about 8.4%, fueled by brisk economic activity as vaccinations caught pace and the movement of goods and passengers shot up in the economy. The finance minister responded to the second quarter performance at a summit, and she said that the first thing that she said was that the Indian economy is largely back to the pre-COVID growth levels. She then said that out of 22 high-frequency indicators that matter, 19 have returned to, or she said that they have surpassed the pre-COVID levels. She then said that at the macro level, we have managed to put the effects of pandemic behind us and we are today on a much steadier growth path. She finally remarked that the government is confident about a sustained growth momentum and is hopeful that this year's GDP numbers will be very encouraging and that India will be the fastest growing economy in the world again. The ever-optimistic India's chief economic advisor said in response to the Q2 growth numbers that he said that he expects the growth rate of India for the current financial year to be in double digits and much higher than the Reserve Bank estimate in the range of 8.5% to 9.5%. He said that he expects the growth rate to be about 6.5 to 7% during the next financial year 2023, and thereafter he expects the economy to grow steadily at 7% per year. He then said that the manufacturing sector has benefited from the government push. The public sector and public sector banks, he says, are much healthier, and he expects a favorable impact of the second generation reforms to set in during the coming months. Yet another expert concurs to say that the second quarter growth touched 8.4% due to high real growth in what he says public administration, defense services, etc., which according to him, the annual growth of 9.5% because of this thus looks feasible this year. The senior Congress leader Shri P. Chidambaram gave a cautious welcome to the reported growth to say that this is not a V-shaped recovery as the government claims very often, and that he says is evident from the fine print. And what is the fine print of this particular growth of 8.4% in the quarter ended September 2021? The fine print says that private consumption expenditure in the second quarter totaled 19.4 lakh crores, which is still less than the figure of 21.7 lakh crores recorded in December 2019 quarter. The consumption or the consumer spending is yet to touch pre-pandemic levels despite this growth. The second issue in the fine print is that the government's much needed capex to boost the economy has already peaked at 13.3 lakh crores in the fourth quarter of the last financial year. It then fell to 11.4 lakh crores in quarter 2 of this year. It shows that the center and the states which are expected to spend and get the economy out of its rut are not doing enough, are not spending enough to support a revival of the Indian economy. The next is that the manufacturing sector has lost buoyancy at present. And finally, the fine print says that the rising WPI means that commodity prices continue to rise, so will inflation, which in turn will erode consumer demand and that will adversely impact the economy. The worrisome fact is that while GDP growth has picked up, consumer confidence and demand has not, and that is evident from numerous recent reports. The respondents in a Sea Voter survey expressed deep concern over their spending capacity and job security, and they were distressed by the catastrophic fall in their family income. About 67% of the respondents in this Sea Voter survey said that despite the steep rise in inflation, they yet expect that their family income will remain the same or that it will actually deteriorate in the coming year. The second survey is of the RBI. The latest Reserve Bank Consumer Confidence Survey says that while the confidence has overall improved, however, the sentiment of the consumer vis-a-vis the economy, his income, his employment and personal spending overwhelmingly remains in negative territory as per the RBI survey. About 72.3% of the respondents expect the economic condition to worsen, of which a little over 40% said that the economic situation will worsen in the year going ahead. Only 19.5% of those polled by the Reserve Bank survey expect their income to rise in the coming year, while 38.4% expect their income to actually plummet or go down. At 19.48 lakh crores for the quarter ended 30th September 2021, private consumption expenditure towards goods and services is still 4% below what it was in financial year 2020, says the CMIE. This expenditure may have collapsed because of the pandemic, but it has been on a downslide since 2014. The CMIE states that the growth in private consumption expenditure has fallen from 16.2% in the period 2010 to 2014 to 12.1% during the period 2014 to 2017 and finally to 10.5% during the period 2017 to 2020, and it shows no signs of a definite uptick. Thus, the consumer is not spending, and that's a matter of concern. Of the four engines of economic growth, namely exports, fresh investment capex, government expenditure, and private consumption expenditure, the last one, which is private consumption expenditure, is the most important one. It contributes to about 55 to 60% of the Indian GDP. The fall in private consumption expenditure reflects the fall in household incomes in India, which corresponds with the rising unemployment and a slowing economy. The key figure that actually serves as a barometer of economic growth in India to us is private consumption expenditure, which has not been going up and which, not surprisingly, the government prefers to remain silent about. This is Akhilesh Bhargava signing off till we meet again. Namaskar.